morning, everybody. Welcome to the trading desk. This is the Armor trading desk. You're a portfolio manager on the desk. You and I are running a virtual hedge fund. This is our morning meeting. I'm going to share with you big picture stuff, risk monitor, any changes made to the portfolio, what the top stocks are that we're looking at, stocks that we might invest in, even though risk monitor's red. We're going to go over that today. As always, take the information. You're the risk manager of your own portfolio, so figure out how it fits into your own strategy. All right. But if you want to know why I'm so negative fundamentally, so I just read and react. I'm looking at algos, and I say algos are red. I got to go to cash, protect, and all that. But the human brain still likes to understand why this is happening. And some risk monitor reds, I just hold cash and I wait. Others, like right now in my aggressive portfolio, I'm short. I'm short indexes and I'm short specific groups. Small cap banks, regional banks, and the home builders right now. So why would I put that trade on when you hear me preach so often to just forget about shorting? Just hold cash, collect your 5.5%, enjoy it, and wait to get on the next upcycle. I'm going to show you one chart pattern that will explain why I'm willing to take some short risk. And what I've done is I've traded it. I've booked some profits on the short side and rolled it into options. Okay. So I have some put options. They go out to October. I'm always a cat on a hot tin roof when it comes to shorts. Okay. So I could be out of these things by the end of the day. I could book my profits and puts if the market gaps down. So don't hold me to that. I'm trading them. But why would I have some assets, short or long puts? I'm going to show you one chart pattern. This is the reason, fundamentally, why this risk monitor red is compelling me to put some money out short. This is the pattern. Okay, global net liquidity versus the S&P fair value. Liquidity drives price. What we're witnessing since May makes absolutely no sense. It's a levitation. This is graphical representation of the S&P 500 doing a Wile E. Coyote off the cliff. That's what this is. Global net liquidity is about to make new lows. S&P is levitating. Now interest rates are skyrocketing. I mean, there's a wall of worry, and then there's the red army. You know what I'm saying? So I'm happy to say, hey, it's a wall of worry, and the market goes up, climbs a wall of worry. Hey, if the risk monitor is green, I'll put this aside, and I'll say to you, okay, I don't understand something. I just don't get something, right? But when the risk monitor goes red, and you see the unbelievable alligator jaw of divergence between global net liquidity and the S&P 500, which almost always follows, right? It almost always follows. Something's off. And I would expect it to mean revert in a hurry. Or all of a sudden, I don't know, global central banks are going to start adding massive amounts of liquidity. I guess that could be. But if I'm ever going to short or own puts, it's right now. When the coyote's off the cliff, that's when I'll do it. I mean, look back here. Look right in here. Right? The S&P ripped higher right in there, and global liquidity was cratering. The S&P caught up pretty quick. That was September of last year. Wow, that's weird synergy right there. So we're in September this year, and the selling has just started. This is why I'm willing to carry some short, carry some puts. This is why I'm very uncomfortable buying or making new investments. I see what's going on in uranium. I see what's going on in shipping. Maybe there's some investments there. I see that energy could turn, and I'm willing to accept that for a while, these assets can go up with the market going down. But I've lived through too many corrections, too many bear markets, too many market crashes where everything gets dumped. And let me tell you something, it happens in a hurry. So if I put capital to work in any of the things I talked about this morning, my stop has to be tight, and I better respect it, or we're going to be ending up holding a bag. And my position size has to be right. Now is not the time for massive risk. So if I put on risk, it has to be the size that makes sense for the cliff that the coyote has run off. Those are my thoughts for you today. I hope you find it helpful. I look forward to working with all of you 9:30 on the live desk. And remember, please take into each trading day that you are the smart money. Think for yourself, make your own decisions, be your own risk manager, be the smart money. I'll see you guys on the other side.